This is Keyed In with Max and Brent, unlocking the minds of the industry's top real estate professionals. And now, here are your hosts, Max Rabin and Brent Jackson.
Hey everybody, welcome to the Keyed In podcast. I'm Max Rabin. It's just me today. Brent is on vacation with his family, and I can do this solo, right? Obviously. So today we have on Dan Maseka and Ross Anderson from Craftwork Capital. It's the first time we've had certified financial planners on the show. They reached out to us. Dan, I think your wife is in real estate. Is that right?
Yeah, she is. She's with Heller Coley Reed team of Long and Foster.
So, and I think you mentioned that she was a listener of our show, and that's how we sort of made this connection.
Yeah, she was with TTR for a while. My grandmother too, Zelda Heller, was with TTR and now Heller Coley Reed, and I'm swept up in the world of real estate.
And it should be noted that Dan and Ross also have a podcast, Check Your Balances podcast. Everyone who's listening right now should subscribe to as well. It's a fantastic podcast. They talk about all kinds of different financial planning stuff, some personal stuff, and you guys have a great conversational and like humorous style. It's very subdued, but I really enjoy listening.
We appreciate that. Thanks for the plug, and we're happy to be here.
So why don't you guys talk a little bit about where you both are from and how you got into the financial world, and just start from there.
Well, I grew up in Bethesda, born and raised, and stuck around for a long time. Went to the Charles E. Smith Jewish Day School and then University of Maryland, so definitely a Marylander through and through. I got started in the world of finance at a young age, actually, when my grandma helped me purchase my first stock. I was in third grade, and she taught me really what it meant to be a stock owner. I was very excited at the thought that I could own a little piece of a company I knew about. And we bought shares of Coca-Cola, and I would track it in the business section of the Washington Post every week to see how it was doing. And that started me on the journey of understanding finance and really got the love of finance and business in me at an early age.
I also am a native Washingtonian. My dad grew up in Arlington, and I've been in the area pretty much my whole life, with the exception of going away for school. I really kind of found the love of finance more so in college, but I always really appreciated entrepreneurship. I started DJing in like middle and high school and DJing parties, and kind of turned that into a little side hustle that literally still exists in my life today, and loved kind of the business side of it and just solving those types of problems. My parents are small business owners as well. And so I kind of came to it through that, and just this love of, doing what you can do and being an entrepreneur and taking control of the outcomes that you're going to have in your life. And that's always made a lot of sense to me. So even in roles where I was kind of an employee as an advisor, I tried to think of it through that business owner lens. And now Dan and I get to work together every day, solving some of those same problems.
So were you guys were working at other firms before you started your own firm?
We were. So Dan and I actually worked together for about 6 years at the Motley Fool, which, if folks are familiar with them, they're headquartered in Alexandria, Virginia. They have some offices around the country and world now as well. But we were part of the wealth management team there, which is kind of a sister company that they were starting at the time, and we left at the end of 2020 to start our own firm. But we sat next to each other, and I really enjoyed Dan's work ethic. We got along very well. There was a lot of, I think, professional respect as well as friendship there. And so we're now on our own as independents completely, but had a great history there as well, and certainly think fondly of those folks.
So when I think of I don't know if you want to talk about Motley Fool, but I have a question, because I'm always like trying to uncover the mysteries of all these various companies. And Motley Fool has still huge brand recognition in the finance world. Any kind of Google search related to stocks will probably lead you to a Motley Fool article. I think that's by design. So when I was using Motley Fool, which was like literally probably 20 years ago, it was more of like almost a subscription service where they offered like trading ideas and stock tips. Is that kind of what you guys did? Or you said you were working in a new division they were trying?
Motley Fool still does offer that subscription-based model. But the team we were with was actually working directly with individuals to build personal financial plans and actively manage people's money. So if you didn't want to do it yourself using the subscription, you could turn over a portfolio to the wealth management team and we would do it for you.
So with your company now, how long have you guys been in business together?
We started at the end of 2020. Really, 2021 was when we first started accepting new clients.
Okay. So pretty fresh company.
Yeah, 2 years in, and I think I don't know exactly if real estate practices follow this same model, but in my mind, it's about a 3 to 4 year getting up to cruising altitude sort of path. So we're definitely still in building mode, but for the fast start that we got out to, I think we're pretty excited about it. It's Dan and myself, and we've got one other certified financial planner that's on our team, Matt, who has joined us as well. And so onward and upward, but we're definitely still in that climbing phase.
Would you care to share how much you guys are managing right now?
So I don't know what it is today. I think our high water mark was about $38 million was the total assets under management. So I think it's pulled back a little bit from that just with the market, but in that 30 to $40 million range is where we're typically floating.
So, and your clientele, like, what's the age range of your clientele? Are you working with like experienced investors or younger investors, like all of us, or what's your clientele?
I usually think of our clientele almost like a barbell, where we have a lot of folks on the tail end, either gearing up for in retirement already, and then we have a lot of folks on the front end who are, finding their footing in their career and starting to look at saving and investing seriously, and they can be in their 30s or 40s.
Mm-hmm.
I think there's kind of two ways to think about what we do in our work, just to understand it. There's the investing side, which for folks that want us to manage money for them, that is something that we offer, where we can take over the portfolio and create an investment plan and then operate it. The other side to what we do is financial planning. And certainly for a younger demographic, that tends to be where we focus that time, is on helping people understand the decisions they're making, helping them understand their savings rate, where are they exposed to risk, and that even if they don't have the wealth created yet, that they're on a path that will lead them to that sustainability and that will help them ultimately get to what they're trying to do. So, things like home purchases, things like, all of those goals are things that we help people navigate on the financial planning side of what we do. And sometimes that is in concert with the asset management business, and sometimes it's completely separate. So it really depends on what we're doing for each individual.
So you mentioned like 30s and 40s sort of as like maybe it's a benchmark. But when I think about you, I mean, Dan, you were talking about how you were buying stocks when you were a kid. Like when I think about investing, I think you want to start as early as possible. I mean, that's pretty good advice for people. What do you tell, like, there's a lot of young adults in DC who are making decent money and they're not so great at saving it. What do you tell people? Like, how do you evangelize saving and investing for younger people who are kind of like, I'll get around to it, whenever I want to,
I think it's honestly two things. So from the mathematical standpoint, compounding, as Warren Buffett said, is one of the great wonders of the world. Starting early, that dollar is going to be so much more powerful today than it would be if you started in 10 years. But I think more importantly, it's about creating good habits early on, because if you don't exercise the saving muscle when you're young, it's going to be so much harder to do that down the road. And if you just kind of rationalize that you're going to be making good money forever, but don't save early on, you're just going to default to spending that money. So having a savings plan that you can start early and start to see the fruits of your labors in the savings department will set you up to continue that throughout your life and hopefully get you to your long-term retirement goals.
Ross,
the other thing I would add to that, and I'll just put in a quick plug for Morgan Housel's book, which is called The Psychology of Money. He talks a lot in that about how wealth is what you don't see. And there's definitely whether you call it keep up with the Joneses or wanting to flex. And when people start kind of making good money for the first time, they want to enjoy it. And I'll be the first one to tell you that I'm not don't enjoy your money, right? Like that, it is a tool to be enjoyed. I am not a proponent of saving to the point of not having fun, because, I think financial planning is this balance between, hey, you might not live another day, right? We are all blessed with the day that we get to live today. And if you don't make it to tomorrow, like, you don't want to have sacrificed everything in terms of joy to not have that, because that's just not guaranteed for us, but also to be preparing for the future. I think that balance is always very in my head. And like, even the name of our show, Check Your Balances, is kind of about that tension, is that, there's a push and pull to all of this stuff. And, I think it depends what your goals are as well. Like, there are plenty of people that a normal retirement age is just fine, right? So maybe 10 to 15% as a savings rate is all they need to shoot for. And then by, mid 60s, they'll be in good shape. Other people want to be financially independent by their 40s. And that's going to take a much more aggressive level of input to get to that and to kind of accelerate that process. So I think it's really dependent on what each person is trying to do with their life. But, we also try not to judge that as well.
Yeah, I read that Psychology Money book. I read a lot of finance books because it's something that I'm personally just very interested in, and I do all of my own financial planning. I know you guys are probably like, well, maybe we should take a look at that, Max, because like, how do I really know? But I read a lot. I do a lot of my own like essential research. I'm not doing anything crazy. I wasn't in FTX or anything. You know what I'm saying? I wasn't doing anything wild. I'm very much like by the book, kind of like how I do my allocations and everything. But I love reading about like the psychology of money. That book's fantastic because people really, you're right. They get money. They're always keeping up with the Joneses, and to me, that's what America is all about. It's like, look at your neighbor. Look, I'm going to advertise this product. Don't you want this exact same thing that they have? And that initial high of buying that, whatever product it is, name your product. The initial high of getting that and having that, it goes away so quickly to me. And so I would prefer just to save it. I'm always like, if I just put like that extra $200 item or $1,000 item or $20,000 item, if I just put that away, that the sensation of needing it or wanting it, it goes away and the money's there. And it's like, that to me that's a much better feeling. That's just me. So
being in real estate is such a tough industry to be in and be frugal with your money too, because talking about keeping up with the Joneses, you're seeing all your colleagues or competitors in their nice cars, looking very put together.
Well, that's a bare minimum,
desirable.
Dan. That's a bare minimum if you're a realtor. You got to have a nice car, right?
Well, yeah, you might have to drive people around to showings. What do you want them to climb into your, 19 whatever hoopty with 300,000 miles?
And I'm not knocking the 19 whatever hoopty either. I'm just saying it's just sort of like part of the trade, right, for realtors. So
for sure. So it's all about finding that balance and making sure that you're investing in your business, because that is in a sense investing in your business, but also taking care of yourself in the long run.
Absolutely. So right now we're in a moment of, so obviously the stock market's a kind of complete volatile mess for the last 11 months. It's not been a lot of fun to look at every day. In fact, I just sort of stopped looking at it. I swear to God, I think 2 months, I deleted the Wall Street Journal from my phone, and I was like, just don't look. You're only going to make yourself miserable. What do you tell your clients who, they've got money invested, they're in ETFs, they're in stocks, they're in other products, and everything's going down, bonds, stocks, everything's going down. And there's no like light at the end of the tunnel. There is somewhere, but not today. What do you tell your clients in that situation?
Well, I certainly think it's been a challenging year, and you're right. The hope in what you're looking for out of a portfolio is some diversification. And the bond market has not provided that this year because the source of the downturn has been rising interest rates, which puts downward pressure on bond prices. Now, I think it depends where you are in the cycle. So for somebody that is looking to retire in the next couple years, there are some things that you can do to make sure the money is there when you need it. Because that's really the first thing that we're trying to do for people in constructing a portfolio is make sure the dollar's there the day you need to spend it and that's not at risk. So short-term money, which for us, we generally define as kind of the next 3 to 5 years, we're trying to protect that as much as possible, whether that means cash, whether that means CDs or bonds that have like a very specific maturity date. So even if the price is kind of going wild in the market, but it's going to mature by the time they need the money. And so that's kind of our plan for at least the shorter stuff. For longer term money, I think especially if you're a younger investor, this is a good time to be getting started. It's a good time to be putting capital to work. And I don't know that we're at the end of this cycle right now, right? I'm not telling people we've hit the bottom, but continuing to be a buyer and not trying to pick the very moment that we bottom out, and continuing to add capital that's going to hopefully be worth more in the future, right? Presumably be worth more in the future. I think in many ways that's a positive thing for somebody that's a saver today. So there's an element of patience to it. There's an element of still building the portfolio that needs to fit, and then also be excited when things go on sale. It's like the one market in the world where prices go down and nobody wants it. And so I think that has to continually be part of your mindset, that we're not bothered by those downturns, but you're trying to look at it as a positive.
Dan, anything to add?
No, I think that's a great summary.
Yeah. When I was a much younger buck, I had some money in investments, and this is 20 plus years ago. We didn't have things like Robinhood, and there wasn't like a ton of, there was financial news, but you had to kind of seek it out for yourself. A lot of people, they used an advisor or a planner, and this gentleman that I had, I think, had me long in some whatever mutual funds that were, like, I forgot what I even call these things anymore because I've sold all these things, but like surrender fees, everything was loaded, right? And when 2008 hit and the market was just like sailing down, me being a young guy, not really understanding everything, I was like, cash me out, dude. I don't want this. Like, this is going to zero and beyond. And he's like, chill out, please chill out. And of course, like, if I just left that money where it was, like, we'd be having a different conversation. Well, we wouldn't be having a different conversation, but it would be a lot more. Like, that money would be there, and plus plenty. What do you tell a client who has that same kind of like panic moment? Like, do you have clients like that? Does that ever happen to you?
Oh, it happens all the time. There has been a lot of reason to feel panic this year. The single day swings have been extreme, and there's no end in sight to what we're experiencing now, even though, rest assured, it will end one day and we will rebound. But it's much easier when you have a plan to point back to. So if you're just investing with the hope that your dollars are going to go up every day, it's very hard to look at that not happen for 11 months running or whatever we're at now. But if you've pieced together a long-term financial plan and say, listen, these are the things we can control and what we're working towards, we're doing the things within our power, and the market never returns the 8% a year that everyone talks about. It happens in a drastically different way with returns all over the place. This is part of the natural cycle. We have to wait it out, and we were prepared for this. That helps a lot. But it doesn't mean that feeling goes away. You're still going to look at your statement in a panic when you see, the declines quarter after quarter. But being able to point to the plan that we've prepared and say, this is what we're working towards, it makes it much easier to stick to it.
So how do you think real estate fits into like a healthy portfolio?
Yeah, I think like Ross said, what we are pursuing in a portfolio is diversification. And real estate is a great diversifier because it acts differently than stocks and bonds. So there is a place for real estate in a portfolio, whether that be owning pure real estate in the form of like an individual home or condo that you're renting. You can get real estate as a traded security in the form of a REIT. So I think that's the biggest benefit for real estate, is just diversification, and you can kind of commit to it to whatever extent you feel comfortable being an active participant.
How do you think of the like REIT performance in general? I mean, it's definitely a way to invest in real estate, but some people definitely want to like get their hands dirty and purchase actual real estate. I've been an investor in real estate for a long time, and people have mixed results. Some people say like, oh, I love buying properties and managing them and having that extra headache. How do REITs perform? How do other like real estate diversified ETFs perform as an asset class?
So if we just look at the actual returns, and this changes kind of each year that you look at the data, but I'm looking currently at a chart that is 2012 through 2021. REITs returned 12.2%, and the S&P 500 over that same time period was at 16.6. So a very productive asset class, where if you look at, bonds or cash or inflation or even commodity prices, you weren't anywhere near those levels. So I think that the equity in REITs was at a very strong level through that period. I think if you go back to the early 2000s and you look at that same chart, REITs have actually outperformed the stock market over that time period. Again, thinking just S&P 500 versus the REIT index on its own. I don't have that data offhand, which I wish I did. So I think they've done very well. But to your point, for some people, they want that experience to be more tactile. They want to see the home. They want to have the key to the home. And that's what makes it feel real to them, where the stock market and just seeing a brokerage statement and that volatility and that fluctuation in the price is the uncomfortable part. So I think it's a matter of understanding how much effort you want to put in. I don't know how much you guys talk about this on your show, but I also think of like, where are you going to add value? Are you a do-it-yourselfer and you can improve the property on your own? You can add a lot of value in that way if you can reduce some of that cost and you do some of that work, or you've got a network where you can do that kind of lower than the market rate, or whatever way that you're going to add value to that property. If you've got that skill set, then obviously I think owning something that's an individual home is going to be a better option for you. I have the opposite experience personally. I've lost money every single time I've bought real estate, even in a booming market. I seem to be very bad at it or making mistakes in some way or another. And so I'm more comfortable kind of taking on that day-to-day volatility personally in a brokerage account because I don't have that same discomfort with it. But I think it's about finding that layer of like, where are you going to plug in? How much effort do you want to put into the management day-to-day? And then how does that ultimately reflect back into, what you're going to own?
Yeah, I hear that. I think when you think about real estate investing, and again, it's a noisy media market. You see people like, oh, Airbnb, you want to have an Airbnb. I just bought 18 units in Ohio and it was only $200,000. And now, using the Burr method, you know what I'm saying? You hear all this stuff, and it's almost like a get rich quick thing. But I think the reality for real estate investing, like you said, it's if that's a skill set you have, that you know how to add value to something. And maybe also it's actually something you enjoy doing, because not everyone is going to know how to hang drywall. I mean, really, you really have to do a lot of things like this to add value. If you're always hiring contractors, I mean, you're spending the money too.
Yeah, I've gotten chewed up in that personally again. But, I think for folks that are in that market, and maybe you guys have a much better sense of what are the up and coming markets, where is the next area that's going to become, the Navy Yard or near the ballpark in DC that becomes this booming place where home values have skyrocketed because of the development that's going on around it. I don't have any sense of having a finger on that pulse, but I think if you do, you can ride that wave, right? That's another way of picking the right market. I don't think I have that skill set. I've always just been somebody trying to buy a place to live and not get hosed doing it. And then I'm not particularly handy. So I get just crushed on all the contractors. I end up spending all this money for stuff. So for me, it hasn't worked out as a great investment, but I recognize that that's not the same experience for everybody.
I have to laugh because this week I literally had a client tell me about an 18-unit place in Ohio that his friend bought and is making a ton of money on.
Are you sure he just said,
shouldn't we
maybe he just saw it on a TikTok and he just, I don't, go ahead. Sorry.
Probably. I don't know. But I always come to that with skepticism, because if it were so easy to buy an 18-unit place for $200,000 in Ohio, everyone would have done it by now. And, it wouldn't be $200,000 anymore.
Yeah. I mean, you mentioned Airbnb. The other thing I keep seeing online, this is an Instagram guy, and I followed him just because this is such a foreign concept to me, but he's talking about arbitraging apartments, where you rent the apartment and then you negotiate with the landlord that you can sublet it, and then you stick it on Airbnb and you end up getting a higher daily rate for it than what you're paying. First of all, the hassle factor in that to me just immediately shocks me. I'm okay, well, I'm not going to do that. But yeah, maybe he's making a ton of money, or maybe he's selling ads on Airbnb, on his Instagram, and that's where he's actually making his money, is telling people that this is great. I have no idea. Those are interesting thoughts to me. So I see a lot of it that maybe I wouldn't do personally, but certainly find intellectually interesting.
Well, we all live in this wonderful, beautiful capitalist economy, right? And I mean, you can't knock people for trying to, I don't know, like make money off of like just the concepts of things, and like these Instagram accounts and these TikTok accounts of, I bought my first Airbnb 2 years ago and now it makes $5,000 a month and blah, blah, blah. And it concerns me when I see this kind of stuff. I don't know that it really added, like all of this noise really added up to anything for my personal business. I'm glad real estate's in the mix with this stuff, but it's like the absurdity factor of some of the stuff I see on social media. Because like I said, I'm a real estate investor. I've bought and sold real estate in my life as rental property, and it is not a walk in the park. Okay, it's a very certain personality type, and for years I was like, sure, I can handle this, and then there was a point where I was like, you know what, I hate this. I just I don't want to get a call like, oh, there's water leaking through the ceiling light. I just can't. I can't do it anymore. It's amazing.
Yeah. On Thanksgiving, you have to drive down
Literally.
there and take care of it.
Yeah. I think we had one. My sister and I, she owned the place and I was managing it in Adams Morgan. And I swear to God, it was Christmas Eve. And the tenants call us and they're like, yeah, there's water coming in through literally every light fixture in this unit. And we're like, okay. Like Christmas Eve, we're over there like mopping, shop vac. Some pipe had burst in another unit in the building because the guy had left town and not left his heat on, frozen pipe on the top floor of this building.
That's terrible.
Of course, Christmas Eve, lovely. So
I mean,
yeah.
Oh, go ahead, Dan.
That's why you have to love being in that business. Otherwise, those days become that much worse. But if you love it, you've taken on that responsibility.
I've got this one.
I mean, that fear, the other piece that this is always in my head, because I don't think I could do this. I don't think I could evict somebody. I've spent so much of my professional career trying to help people make good decisions with their money and then ultimately do as much as they possibly can with whatever resources they have. I don't know that I could look at somebody that's down on their luck and be like, you're out. And just emotionally, not to say that that's bad or that people that evict people are wrong, right? It's a business. You've made an agreement with somebody that they're going to pay and then they stay. And if they don't, then they won't. But I just don't think I could do it. And the fear of even having to go through that keeps me out of that transaction. Because I just, if you can't picture yourself going through it when it's going bad, then I don't think you should picture the joy of it going really well. And that's always been in my head, at least. It's
a really interesting thought, because it's sort of the same thing with stock investing. It's like you do like a risk analysis for people. It's like if your returns, if you opened up your statement and you saw it was down 50%, would you throw up or have a heart attack? Then maybe we shouldn't be so heavy and whatever, and similar. Yeah.
I mean, the other thing, and you mentioned TikTok, and I think that we're seeing this play out a little bit with what's going on in the crypto space. And Dan and I have not been particularly loud crypto advocates in any way. We've been kind of on the sidelines with it. Is you start to feel stupid when you're looking around and you're watching people what looks like make really easy money. And I think that you're kind of alluding to that as well in real estate, is that you'll see people come out and say, oh, this was really easy. All you have to do is this. And they just kind of present it in this like, hey, dum-dum, why aren't you making tons and tons of money?
Yeah.
And you go, what am I missing here? Am I not smart enough to do this? And they're not necessarily showing you the whole story, right? And that's the really important thing, is that if you don't see the other side of it or what they had to do, or maybe they got lucky, or maybe they're just making stuff up, and you can start to get this FOMO and feeling left out, where, if you get comfortable with how you're going to be an investor, what asset classes you're going to be in, stay in your lane, right? That doesn't mean don't learn things, doesn't mean don't explore them intellectually, but don't get drawn out of your comfort zone because it looks like people are making easy money. Because I think that's a really quick way to end up kind of upside down.
That's a beautiful and perfect statement, and it applies to so many different things, not just investing, right? I mean, just you're going to see a lot of stuff out here and you're going to think you can be a part of it. And the answer is, it's not always going to be for you. So there you go. So we got Dan Maseka and Ross Anderson. They're with Craftwork Capital. They're certified financial planners. They also have a fantastic podcast called Check Your Balances, which you should absolutely 100% subscribe to. About realtors. So realtors make money. You guys mentioned this in sort of our pre-interview discussion. Lumpy cash is a term you use. I've never heard that before, but I was like, lumpy cash? What is? And I was like, oh, and then I realized, like, obviously you get big checks, like momentarily you get a big sum of money and then you get nothing for a month. So you were going to talk about how you can help people who make money this way invest, because usually what you're doing, if I'm not mistaken, is most people are just W-2 employees. They're making a sort of set amount of money every 2 weeks. They take some money, put it in their IRA that might be through their company, et cetera, or they might have an IRA with you, or they might have a brokerage account with you, and you're just sort of putting the money aside. Dollar cost averaging is usually the number one tip out there. So how do you deal with the realtor who's like, hey, here's a $50,000 check? How do you do that?
So it's all about planning and putting money in the right buckets and understanding the kind of the cadence of your monthly expenses. And the first thing is you want to set yourself up for success by building a reserve that's large enough to live off of commission check to commission check. Because, maybe you do 5 really big deals a year, but they happen bookended, who knows? And you might be running on that check for months at a time. And it's kind of demoralizing to see that money gone and to be spending on a credit card just waiting for the next deal to come through. So it's about understanding your expenses, preparing for that, setting up a reserve probably greater than you would otherwise need if you were in a normal job, because you don't know that the next check is coming in 2 weeks. It might be 6 months. And then also setting up the systems for saving, because as a self-employed 1099, professional, you don't have those systems in place to just have money withdrawn from your commission check and go into savings. It takes extra work to do that. So you need to put that as part of your plan, because if you don't plan for savings, you're just going to be spending. So mapping that out, understanding where those dollars are going to go when they come in is important, instead of just defaulting to whatever's going to happen. Because what I found, again, if you're not planning for something, you're just going to spend it all whenever the expenses come up, because it's easier to do that than to sit analytically and look at it and say, well, in 2 months I have to pay this expense, and then my G car renews then and I need $1,000 for that. So just having a plan on paper means so much.
So I like to think about this analogy of whether or not your income and kind of your work life and your human capital as an income earner, like, are you a stock or a bond, right? And so we think of like a government employee, somebody that gets the exact same paycheck 24 or 26 times a year. They're kind of like a bond in their work life, right? Very little variability. They're going to be able to set their budget really, really simply. When you're introducing more variability to that, because you've got that variable income component, you're more like a stock. It's a little bit more uncertain, and you've probably got way more upside that you're kind of trading. But then the question is, well, how do you introduce that safety net on the other side? And to me, that can be from a couple different ends. Are you introducing like a second source of income? Are you kind of becoming a multi-stream income person, whether that be from a rental, whether that be from an income producing portfolio, whether that be from like a side hustle? How are you smoothing that income out? I think certainly for somebody early in their career, that's going to be maybe necessary as you kind of get a real estate business up and running, is that maybe you're transitioning out of other work into real estate, and real estate is the side hustle, or maybe it's vice versa, right? So how do you add income somewhere just to kind of smooth that out? Or if not, where do you put the resources so that you can kind of, squirrel it away, right? You can add that sustainability by having extra cash and by adding extra safety net on the asset side. So those are kind of the other things. I also think controlling your expenses and just kind of your monthly overhead. Like, if you're going to have kind of that bigger up and down wave, for me personally, I know there's things in my budget month to month that I could immediately drop in a very lean month, right? I tend to spend a lot of money going out to eat. Like, that's kind of where my budget leaks. Is I like good food. but I also know that I can immediately control that. I could throttle that down by hundreds of dollars a month if I had to. I hope I don't need to, and I try and again build that safety net in, but I know where that flexibility lies for me. If I had to add a renter and add somebody in my home and just rent a room out, I could do that, right? So I kind of think along these lines of like, how bad would it have to get before I start kind of pulling these levers? And I've just thought about what those would be. So I think that's the other thing is like, where do you have control over your expenses and how flexible are they? For somebody that's got, a spouse and kids and, much more obligations kind of built in, that's tougher. It's really tough. But for somebody that's younger and can be flexible about those different things, I think that's what we need to look at is how do you pull the whole plan together and build the safety net?
So, quick disclaimer here that we're not like outright giving stock advice or stock tips. We had a guest on a couple of weeks ago, and she used to be in the she was sort of a data analyst before she was in real estate, and then we started asking her about what stocks she likes, and she started giving stock tips, and we were like, we got to put some kind of disclaimer here because people will listen to this, start writing this stuff down. But I just have these questions because this is what you guys do. Number one, in the investing world, what do you think is the better investment, stocks or real estate?
I tend to so the answer is both. You should diversify. I like thinking of stocks more. It's just jives with my personality because I'm business focused. So I like thinking of a company and the products or services they create and how they could add value through developing those. That story resonates more with me. I'm a business owner. I co-founded a brewery, and just like thinking of how can this brewery do more, if we invest in it, what kind of things should we be doing there? With real estate, I think there can be a component of that, but it's just not an area I'm as comfortable with personally because I don't know a ton about different real estate markets. So I like playing in the stock space more. Also, you can get a lot of different flavors of stocks. So, that's a bigger pond to fish in. But I think, the true answer is you should dabble in a little bit of everything because there's no telling what the future holds. So you should make sure that you have a little bit of this and a little bit of that to help push you forward towards your ultimate goals.
So Warren Buffett talks about investing in productive assets. That ends up being where me and Dan are probably most in alignment, is that we think you should invest in things that either do or can generate cash flow. By definition, by the way, that also starts to count out things like crypto in most cases. It counts out things like commodities and gold, where we're not big proponents. Now, that can be a ballast in a portfolio. Ultimately, there's a lot of value to just having that diversification, but that tends to not be where we're as excited. But things that generate cash flow. That could be a small business that you invest in that's ultimately going to be productive. It could be a real estate portfolio. It could be a stock portfolio where you have ownership in those businesses. It could be bonds where you're really becoming a lender to those companies, to those municipalities. That's going to be a lower returning sort of program. But again, certainly as people are getting older and getting closer to retirement, adding that in. But that productive asset, I think, is the definition that I'm most comfortable with, is how is it going to generate cash flow for me and how will that cash flow grow over time? So yeah, I think there's definitely room. And as we've mentioned, there's traded REITs. There's all sorts of ways, whether you're investing in real estate or stocks, that those actually really commingle a lot. You've got businesses that own massive real estate portfolios as part of their business, right? So I don't think that we can separate them and say one's better than the other. I think it's about understanding what part of the market do you want to be exposed to.
So what do you think of the major tech stocks that were like the FANG trade, or there was like different acronyms for like Facebook, Amazon, Netflix? These big stocks have taken mega hits in this last cycle. Or do you think these large tech growth stocks are done? Do you think this is just part of the cycle? What do you think about those big names?
So we do need to be careful just because of how we're regulated. So we're not going to talk about any specific name, and that's we're Dan and I are what's called a registered investment advisor. That's how our firm is set up, and so we have some structured things that we can say and can't say.
Ross is our compliance officer.
I am
if
our
it wasn't
compliance
clear.
officer.
Clearly.
Now, so as a category, the sell-off in tech and the sell-off in high growth, which it's really been whether you're talking about the big names or the smaller names, I think there's a couple different things to look at. When you're valuing a business, it ultimately, I'm going to sound like a broken record, it comes down to cash flow, growth, and risk. Those are the only things that play into value. And then there's price, which is what are you going to pay for that, right? And what multiple are you paying for that? So in real estate, that's going to translate into like a cap rate, right? Like what are you getting in terms of a rental yield for your purchase price, essentially? We can think about the same thing in stocks. We can think about an earnings yield and like how much am I paying for each dollar of earnings or each dollar of revenue that this company is going to get. That's where you've seen the most compression. In many of these cases, I haven't seen a big slowing down of the business, right? You're starting to see it. I think we're kind of finally heading into that cycle. You've seen some over hiring in those spaces where you've gotten these companies that have gotten really big. There's been quite frankly, I think there's been a just rush, like a gold rush for the talent. I think just to get enough people on board and make sure that they're not scrambling to hire people and then having to overpay, they overhired a little bit. That's going to correct itself. And so you're seeing that. That can be a painful process for those going through it. And so as those businesses kind of right-size themselves, but I don't think that the story is over for a growing business. Right. And, so that's really what we're looking for is the business growing? And then when you're looking at a downturn, if you're looking at downward pressure on the price, is it just because people aren't as enthusiastic, or is there actually a fundamental flaw in the business? And that's what we have to try and evaluate as investors is what is really happening here. If it's just people being less excited and the pricing pressure is downward, that to me is not necessarily a reason to abandon the idea.
Fair enough. So here's an interesting question. If someone is in debt, do you advise hiring a financial planner?
So I think there are a lot of different flavors of being in debt, and sometimes a financial planner can help. Some people are just poorly organized or just have trouble, putting a plan in place that they can execute, and then also having an accountability partner. It's like going to the gym on your own might not yield results, but having a coach there or a trainer there might get you to where you want to be quicker. So for some people, I think a financial planner can be very helpful. At the same time, there's some people where the problem isn't purely organization or just having a plan. And I think some people have a deeper rooted issue in their relationship with debt. Ross and I spoke with a financial therapist recently, and I think for some people that debt problem might be rooted in like a trauma perhaps. And if you can't unpack what that trauma is, you might not be able to solve your debt problem. So I think sometimes the answer might even be you need a therapist because you are seeking happiness through your relationship with buying things, and that's creating debt. And if you can't get to the root of that, you might not be open to listening to a financial planner because they're just going to say, here's what you should do with your money. But that's not speaking on the level that you need. So, I think having someone to help is important. It's just a matter of finding where that relationship is most productive, either with a planner or a therapist, which can come in the form of like a true mental health professional, or there are some financial planners who are also trained as financial therapists.
Excellent.
Yeah, I mean, that's a great answer. It depends where you're having the trouble. Right? Like what help do you need, and are you self-aware about it? Or is it something where some restructuring can be helpful? Some people just can't get off the credit card cycle and they're just spending in advance of earning the money, right? That's a hard cycle to break if that's how you're used to managing your cash flow. And I bet that that's pretty prevalent in the real estate community because of that lumpy cash flow we're talking about, right? You're expecting that next commission check. You've got a deal in the pipeline. You're hoping that when it's going to close, and you're going to spend the money in advance of that. To flip it to the other side where you've earned the money in advance of spending it, and then you're spending from a cash reserve, that's a meaningful shift. It really is. Just behaviorally, that's a very meaningful shift to get across that hump. For some people, They just need the business to mature, and they need to get ahead of their own cycle. For other people, they need some input on how they should be managing their cash flow day to day. And maybe it's a system where you know roughly what you're going to make over the course of a year. You set up kind of a cash reserve, and then you almost pay yourself a salary out of it, right? We're finally seeing some better yields on like savings accounts. So maybe it's a system where you put the commission check into a savings account, and then you drip yourself out a monthly paycheck, so to speak, as you're spending money, right? There's a bunch of different ways to kind of handle it. I think it's what do you need from us, right, as planners or whatever source of help you're looking to. And sometimes you know exactly what you need and you just haven't done it. The gym is a great version of that. We all know we should be exercising, we should be eating healthier. Sometimes we need somebody else to kick our butt a little bit and get it in gear.
Fair enough. All right, Dan Maseka and Ross Anderson from Craftwork Capital, thanks so much for coming on. You've got you added some great value here for our listeners, talking about just the general topics of financial planning. And I just really enjoyed our conversation. I just really want to thank you guys for coming out.
Thank you so much for having us.
It's our pleasure.
And another reminder to our listeners to check out your podcast also. Check Your Balances, available everywhere you listen to podcasts. I'm a listener. It's part of my weekly ritual too. So guys, great material. Love that. All right. So now I'm going to hit you with some rapid fire questions. Brent usually does this, but I'm going to do this. So, my questions are going to be better anyway, because, sorry, Brent. So financial guys, I'm going to ask you, both of you, Wall Street or Boiler Room? What's your pick?
I'm going to go Boiler Room.
I'm also going Boiler Room. Some of the greatest lines in sales
yeah.
history came out of that movie. That's an incredible movie.
Hell yeah. That's one of my favorites.
The you couldn't close a window. That's not even a pivotal scene in the movie. I love that when he yells that at the guy. You couldn't close a window. You don't get to sit down for the rest of the day is just an amazing berating of a salesperson. I crack up every time he says it.
The Vin Diesel, like putting the speakerphone on with it's ridiculous. It's one of the funniest movies I've ever seen, but it's hot. It's hot.
It's awesome.
Okay. I'm going to watch that again this week. I'm glad I reminded myself of this film. All right, let's see. Favorite hobbies, each of you?
Mine is playing music. I love playing guitar.
Oh, man. I am also a musician. I'm a drummer, but I have been a DJ for a long time, and that's probably where I have the most fun on the music side is DJing.
Nice. We all share that. I was talking a little bit with Dan also. I've been playing guitar most of my life, too. Not as much lately, a little busy, but we're all musicians. That's great. What is your obsession with burgers? You guys talk about burgers on your show a lot. What's the deal?
I feel like a burger is the perfect food. It's handheld. You can do it up. You can do it down. It can be casual, fancy. You can dress it however you like. I mean, who doesn't enjoy a burger? You could go vegetarian burger, meat burger.
It's
There's
just like
always
the
an
perfect
occasion.
combination of food, right? Like it's like a well-balanced meal inside this one sandwich.
Little bit of salad in there.
Yeah, no, exactly. Like if you like sweet flavors, if you like savory flavors, if you like cheese, like whatever you like in terms of a flavor profile, you can get in a burger. There's nothing that like beats it as a format for how do you want to ingest that flavor profile.
I mean, it's one of my favorite things of all time. I just need to learn how to get over the guilt of eating one. I don't know why there's a guilt attached to it. I'm old enough to like take care of myself. I think I can have a burger. What are you guys binge watching right now?
I just finished the newest season of Great British Bake Off, and now I need to find my next show.
Yeah, I haven't been binge watching much. My comfort show is The Office. I know so many people that have just watched it over and over and over again on repeat. I am one of those people. If I just need noise, that tends to be it. But I haven't been binge watching anything lately.
Okay. And then lastly, you guys mentioned Psychology of Money by Morgan Housel. Can you guys give me a couple more books that you like or that you're currently reading? Doesn't necessarily have to be financial, but those are great too.
So one I'd recommend is called Richer, Wiser, Happier by William Green, where he talks with a lot of the greatest investors of our time, and you really get a glimpse into their habits, both for work and life. Highly recommend that. I am currently reading a book called Spaced Out by a high school friend of mine, Mike Prada, who talks about how the three-point shot revolutionized the game of basketball.
Nice.
So I just sat for an exam, and so I have not been reading for pleasure in recent history. I've been studying every moment that I probably could be reading. But one that I've had on audiobook that I'm looking forward to getting back into is called How the World Really Works. I just had to look up the author. It's, I'm going to say it wrong, Vaclav Smil, Vaclavsmil is the gentleman's name, and I apologize if I'm completely butchering that. But he just breaks down in pretty great detail, like how some of the fundamental structures of the world, like how our energy system works. And the chapter I'm getting ready to get into is like how our food system works. These like really critical pieces of our daily life that I don't think we understand as consumers. I'm excited to get back to that. And that's been on the shelf for a little bit.
Well, Dan and Ross, this has been fantastic. I really enjoyed our hour and I really appreciate your time. Thank you so much.
Thank you.
Thanks for having us.
And we also always donate to the charity of our guest choice. Do you have any charities you'd like to give a shout out to?
I'd like to give a shout out to the National Brain Tumor Society. It's one that's near and dear to my heart. I always take a chance to support them when I can.
I will second that for Dan. I'm not going to add to that and take away the thunder from it.
All right. That's fantastic. Thanks so much, guys.
Thanks for listening to Keyed In with your hosts, Max and Brent, unlocking the minds of the industry's top real estate professionals. For more information on selling your home, find us online at KeyedInPodcast.com. Remember to subscribe to Keyed In on Apple Podcasts or wherever you like to listen to podcasts. Follow us on Instagram at Keyed In Podcast, at Rabin Max, and at Brent E. Jackson. And follow Max on TikTok at MaxwellRabin_properties.